First of all, thank you, Sunil, for those very, very kind words. And my compliments to FICCI for having made this an annual feature, the Capital Markets Conference, and something that people look forward to. Also, my compliments for having got almost all of SEBI to come today, starting with the chairperson and 3 members, one after the other. In fact, in our weekly meeting, we were scratching our heads and saying, what do we say so that we don't overlap with each other and kind of keep you interested. I didn't realize I'm going to get the graveyard session though. And, if I had known this earlier, I would have told Kamlesh to do a swap or something, but we are where we are. So once again, I've got a nice speech prepared. So in case you want to go to sleep, this is a great time. 20 minutes, you can go to sleep. So let me again thank FICCI for having given me this opportunity to address your 21st Annual Capital Markets Conference. In this address, I will look to provide some perspectives of SEBI around capital formation using the specific example of a topical issue, equity derivatives, also known as futures and options or simply F&O. I will look to cover the recent positive trends in investor participation in capital markets, list 4 points to ponder, including around F&O amidst the good news, explain SEBI's regulatory approach vis-a-vis F&O, and then suggest some broad takeaways around regulation and self-regulation. As you are aware, SEBI's mandate centers around investor protection, market development, and market regulation. Put together, our role is to facilitate sustained capital formation in our country. We live in exciting periods for capital formation, led by a marked increase in participation by individuals and households as investors in our capital markets. From 2.2 crore unique mutual fund investors as of March 2020, we had around 4.7 crore unique mutual fund investors as of June 2024. Similarly, from 3.6 crore unique demat holders as of March 2020, we had over 9.6 crore of unique demat holders as of June 2024. An increasing number of investors are bringing in their financial savings into our capital markets. During the 6 years from FY16 to FY21, on average, mutual funds, other domestic institutional investors, and individuals net infused around 40,000 crores on average each year into our equity secondary markets. This is a secondary market net inflow. Since then, for the 3 years from FY22 onwards, they have brought in on average around 3.1 lakh crores annually into our secondary markets, nearly 8 times higher than before. Besides healthy corporate earnings and stable macros, an efficient and robust technology architecture that forms the backbone of our trading, clearing, and depository ecosystems have undoubtedly played a crucial part in this ongoing journey on encouraging greater participation in our capital markets. This higher participation may have set off a self-reinforcing cycle of strong returns in our markets, hence drawing in even more investors into the fray. With a compounded annual growth rate return of around 15% in dollar terms over the past 5 years, our markets clearly are amongst the best in the world today in terms of sheer returns. 5 years ago, India had a weightage of around 9% in the MSCI EM index. Today, that number stands at 19.2%. Even as there is much to celebrate, there is very little room for any complacency. Collectively, all of us, industry, market participants, policymakers and regulators, analysts and commentators, and investors, must preserve and nurture our capital markets ecosystem, the goose that is laying the golden eggs. There are areas that warrant attention. I will briefly touch upon three of them and then spend some additional time on the fourth, trends in derivatives trading. First, while we celebrate our technology, collectively, we have much to do to ensure continued technological and cyber resilience. It's a big area that we have to concentrate on. Second, while we celebrate the steady transformation of the Indian saver into an investor and the consequent increase in market capitalization, we must consider the current mismatch between the demand for securities and the supply of securities. The 3.1 lakh crore of net demand for secondary paper brought in by mutual funds, domestic institutional investors, and individuals into the secondary market every year for the past 3 years far exceeds the roughly 2 lakh crore of annual primary market issuance spanning IPO, FPO, preferential allotment, QIP, rights issues, and even OFS. Prolonged mismatch of this nature can leave us with more of asset price inflation rather than capital formation. Anecdotally, the price of over 30% of mid-cap and small-cap stocks have more than tripled in the last 3 years. While there can be any number of arguments to justify these and other prices, we need issuers, including many members of FICCI, to step up to the opportunity, raise risk capital from our willing investors, deploy it and create new businesses and household savings, and hence ensure that capital formation sustains as a virtuous cycle. This is clearly a larger point for a greater debate. Third, there is certainly a need for increased investor education and awareness. My fellow whole-time member Kamlesh spoke earlier about some of the challenges and our responses on that score. However, for today's address, I will concentrate on a fourth and topical area, the growth in interest in equity derivatives in recent times. First, let me be very clear about how SEBI views derivative markets and risk takers. There can be very little doubt that our capital markets ecosystem needs both. Derivative markets, market makers, and speculators aid price discovery, help improve market depth, and provide avenues for issuers and investors to hedge their risks. A healthy derivative market and risk-taking ecosystem aids capital formation. The question is of degrees and balance. That is, ensuring that collectively the cash and derivative market ecosystem is supportive of both investor protection and market stability, and hence of sustained capital formation. As the consultation paper on the draft FNO circular brought out by SEBI a few days ago on 30th of July points out, there has been a remarkable growth in trading of index options in recent years. While cash market annual turnover increased by just over 2 times between fiscal year 20 and fiscal year 24, index options annual turnover on a premium basis has risen by over 12 times from rupees 11 lakh crores in FY20 to rupees 138 lakh crores in FY24. It is worth noting that index futures turnover did not change that much during this period. What explains this explosion in index option volumes? The proliferation of weekly expiries for index option contracts to a stage where every day of the week has an index option expiry has clearly had a role to play. There are contracts where well over 90% of the trading volume in index options occurs on the expiry day, with a significant concentration in the last hour of trading. On expiry day, all other things being equal, the time value in an option premium is naturally at the lowest, and it continues to drop through the course of the day. As such, progressively through the course of the expiry day, a speculator can buy option structures with a very small capital outlay, which can possibly provide a large profit if the index were to move only by a few points. This optically cheap option premium, which might be as low as a few hundred rupees as we approach expiry time, appears to entice a whole bunch of individuals to trade in and out on expiry day through the day. Trading in index options specifically close to expiry then starts to resemble a slot machine in a casino, with individuals putting coins into the machine hoping to hit the jackpot. Please note, it would be unfair to compare all of equity F&O with a casino and to lose sight of its utility in capital formation. That's not what we are saying. We are talking only about the specific portions of options trading closer to expiry. It's a very focused area as far as we are concerned. NSE data shows that over 92 lakh individuals collectively lost close to 52,000 crores during FY24 in index derivatives, even without considering their transaction costs, which are substantial. 99% of these individuals traded in index option. Only 7% traded in futures. During a different period, the transaction cost stood at an additional 35% of the trading losses as per the January 2023 study, option study of SEBI. The finding of the January 2023 paper that 9 out of 10 individuals lose in F&O trading broadly continues to play out. The offsetting gains largely reside with some sophisticated algo-based domestic and foreign high-frequency traders. This frenzied hyperactivity in index options on expiry day has little discernible benefits while raising several issues. It would require extreme levels of imagination to be able to attribute any kind of constructive support for market-wide price discovery, hedging, or capital formation from this hyperactivity in index options on expiry day. In addition, to put the numbers in perspective for capital formation, the net trading loss borne by individuals during FY24 in index derivatives, as described in the paper, consultation paper, is nearly a third of the net inflows into growth and equity-oriented schemes of all mutual funds during FY24. These are certainly not insignificant and indicate that money that could be put into constructive capital formation is being frittered away at scale. Finally, the frenzied trading on option expiry day also raises questions of market stability and possible vulnerability to manipulation. Market open interest rises during pockets of the last hour before expiry amidst very low option premiums being dealt. If there were to be an unforeseen black swan global market moving event minutes before expiry, amidst this frenzied activity and risk-taking, the resultant impact on the overall market ecosystem can be substantial. As a regulator, we are conscious that we must not throw the baby out with the bathwater. When it comes to the frenzied trading in options nearing expiry, however, it is very difficult to see any baby in this bathwater. In short, a primary regulatory intent now is to specifically curb only this expiry day frenzy in options trading and to reduce the systemic risks arising from this. 5 out of the 7 proposals of the July 30th consultation paper, i.e. restricting the number of weekly option expiries, increasing margins around expiry day, removing the benefit of calendar spreads on expiry day, requiring the monitoring of intraday positions, and rationalization of option strikes are centered around this objective. The 6th proposal to increase lot sizes is simply to reset them considering the movement in markets since then, since they were first set up. The current lot size of 5 to 10 lakhs was set in 2015. Markets now are 3 times of the 2015 levels. The corresponding increase in lot size is unlikely to impact index option trading per se, since the option premiums are typically a tiny fraction of the notional. However, note that futures carry risk too, by virtue of their inherent leverage. Incidentally, while already far fewer individuals tend to trade in futures than in options, given the lower outlay required for options, the SEBI F&O study of January 2023 shows that the average net loss made by individuals is almost identical, both in futures as well as in options. It's not that one is better than the other. The seventh proposal, the explicit requirements that brokers need to collect option premium from investors that are buying options, is simply a matter of basic hygiene. It's nothing, earth-shattering there. Through all these 7 proposals, we have taken care to ensure that the steps do not restrict avenues for trading, market making, or hedging in the broader F&O ecosystem. Any number of contracts can still be launched with monthly expiries as before. These provide ample room and scope for hedging and trading and speculative activity. We only propose to specifically address the issue of hyperactive trading on expiry day options and reset derivative lot sizes to account for the movement in markets over time. Naturally, the process does not end here. Even after the current consultation and the final steps that are eventually taken in this regard, we will continue to monitor activity in F&O markets and in a consultative fashion consider fresh steps, both developmental as well as regulatory, as necessary. In addition, both the expert working group for F&O and our secondary market advisory committee will debate other structural issues relating to derivative markets, including ensuring that we are measuring and monitoring risks accurately and ensuring that there is some balance and connect between the underlying cash and derivative markets. As ever, we remain open to other suggestions from all market participants on ways to develop the F&O market better to ensure that capital formation ensues. Finally, and in summary, I offer some personal observations around the process of regulation that our capital markets ecosystem follows. I wish to compliment members of the market ecosystem for their engagement and constructive involvement in the regulatory process. The expert F&O working group that we have constituted under former RBI Executive Director G. Padmanabhan has members from key market infrastructure institutions, brokers and broker associations, investor representatives, market participants, academics, and other experts. The Secondary Market Advisory Committee, chaired by former SEBI whole-time member G. Mahalingam, has similar wide representation. For some of the members of these groups, it can be argued that some of the proposals may have short-term negative revenue implications. Despite that, we have found that by and large, our market participants are mature and are able to take the broader perspective of what is in the best interest of our ecosystem. Independently, many of them have been taking sincere steps to enhance investor awareness and to manage overall risks better. This is truly appreciated. I strongly believe that while the steps that we take to enhance investor protection, preserve market stability, improve market efficiency, reduce risk, and enhance transparency can appear to have short-term negative revenue implications for some, ultimately, given the sheer size of our opportunity in capital formation and the crucial role that our capital markets play in this journey, the size of the opportunity pie will only grow over time. On the contrary, not taking timely steps along these lines can threaten the market goose that is laying golden eggs. Please continue to take the medium-term view and stay trusted partners to the ecosystem. One suggestion: as we mature, it would be ideal if much of the regulation comes via self-regulation than waiting for SEBI to act. A suggestion which has been made by some market participants is around introducing client suitability and appropriateness factors as a filter to allow participation in F&O markets. For several years now, brokers have already been required to collect financial data around investors before allowing them to trade in derivatives. Nothing stops the ecosystem, sans SEBI, from collectively setting up standards to achieve this better. Similarly, we must look to self-identify and address any possible perverse incentives in the ecosystem. As an example, volume discounts offered on exchange fees to certain trading members resulted in them collecting around 2,700 crores more from investors as exchange fees during FY24 than was due from them to the exchanges. This resulted in possible perverse incentives where larger brokers would benefit from channeling larger trading volumes from their clients, even if notionally the explicit broker charges were very, very low. While we have collectively addressed this issue, ideally, much of this could perhaps have been raised, debated, and addressed by the experts and participants on the ground without having to wait for SEBI's intervention. On a lighter note, if we were to watch our diet, exercise regularly, and do a periodic medical checkup, we should reduce or at least delay the need for any intrusive medical intervention. Similarly, an ecosystem that self-regulates would hopefully reduce the need for a surgeon like SEBI to step in. I think that ecosystem, to be fair, is doing very well in constructively looking at the big picture. But personally, ye dil mange more. In conclusion, for our part, we in SEBI commit that when we look to act, we will do so as we do now, in a thoughtful manner, in a transparent manner, in a consultative manner, sifting through all the noise of the varied and diametrically opposite advice that reaches us, and strive to ensure that while we stop bad things, we do not come in the way of good things in our journey towards capital formation. The modern Hippocratic oath, first do no harm, is right behind me, behind my table. Once again, I thank FICCI for this fantastic opportunity. I hope I've put you to sleep for about 20 minutes. You can now wake up. Thank you very much.